Thank you very, very much for joining us right here on ET Now. This is the India Development Debate and I'm Supriya Shrinate. Let's go straight across to the IMF growth forecast that has lowered India's growth for the current year by just a notch at 7.3%. The IMF is highlighting broadly two big issues. One is the rising oil prices and the current account situation that makes it vulnerable. Global growth has also been lowered from levels of 3.9 to 3.7%, and all of this is happening at a time when the government is trying to prime push the Indian economy. The reality is that this move is coming in at a time when India needs more investments, more jobs, and we are less than a year away from general elections. The IMF's growth forecast, not just for the globe but the world, but our world at large, is our big topic of discussion and debate right here on the India Development Debate this evening. Let's take this across to a panel that's joining us right here. Maithili Bhusnurmat, our consulting editor, Anant Narayan, and Mr. R. Gopalan. So thank you very much, each one of you, for being with us. And Maithili, let me begin with you. The IMF has, by just a notch at 7.3%, India's growth forecast, 7.4% in the next fiscal will make, the present fiscal will make India still the fastest growing economy, even ahead of China. Is this at all any good news amidst a sea of gloom that seems to be coming our way as there's a currency rout and equity markets headed south?
Well, Supriya, I must say that all GDP estimates, including that of the IMF, must be taken with a pinch of salt, because very often the estimates are way off the mark. Having said that, yes, it is good that the IMF has retained India's growth for this fiscal at 7.3. They had lowered it a little bit in the January outcome, but now they have retained this year's at 7.3. Next year's has been downgraded a little bit to 7.4%, even at a time when the entire world growth has been lowered a little. To that extent, it's good news for India, but is that good enough? Most certainly not. A, because it is below our potential. B, it's way below what we really need to grow at, because remember, India is also the house to the largest number of poor people living below poverty line. So merely the fact that we are the fastest growing is just not good enough. So it's good news, yes, but one needs to take it with a pinch of salt, not only because the estimates cannot be relied on 100%, but also because we need to grow much faster and we have the potential with the right policies. Unfortunately, we always fall short.
Okay, so we have the potential and we need to grow faster to cater to an economy and to a bunch of people who need dividends from growth. But Anant Narayan, where is this optimism really stemming from as far as the IMF is concerned? At 7.4%, yes, we will be the fastest growing economy in the world, but look at the negativity that's come our way. The current account deficit, the depreciating rupee, an RBI that's extremely hawkish. In this sea of negativity, where is this optimism stemming from? I know we are growing still well below our potential, a lot less than we really need to cater to a population that's needy. But having said that, why is optimism really the order of the day as far as the monetary agency is concerned?
Well, I can't speak for IMF, Supriya, but I would be optimistic about India in the medium to long run. I think the demographic dividend will play out, though there are fears that it might taper off. And I think the people in this country are good enough to eventually grow out of the morass and get into a space. Having said that, what you said about the negativity currently is absolutely right. In fact, ironically, I think at this current point in time, high growth might not be good news for us. I completely agree with Maithili that we eventually need high growth. But in the current state that we are in right now, it might just exacerbate the issues that we have right now. Supriya, look, our external context is looking horrible. You mentioned oil prices, global interest rates are going up, money will go out of emerging markets, Iran is coming up, we have elections coming up. So it's a very, very complicated external sector. And we have three of our own vulnerabilities. The external sector, which is looking terrible. We have our own banking and financial system, ecosystem as a whole, which is also looking pretty weak. And finally, our fiscal deficit, I think the quality of the fisc will start to break as well. So we have a problem of twin deficits which could come up. And at a time like this, having high growth can actually feed into the external sector problems and can actually be unsustainable from a fiscal perspective. Remember in 2010, 2011, our growth numbers are pretty good. But that led to an issue of 2012, 2013, where the entire system threatened to collapse. So, we need our basics and our fundamentals to be sound. We need it to be sustainable growth. And at the moment, given these three problems that we have, I don't think we can quite achieve sustainable growth, no matter what the real politic is.
Okay, so we need higher growth over the long term, but for now, high growth is going to be counterproductive, is the word that's really coming in from Anand. Mr. Gopalan, how much do you agree with that? At a time like this, is it all right to tighten our seatbelts and say, let's live through this low, perhaps benign growth phase? Let's not be too ambitious to ask for high growth, because high growth will come with its own set of problems. And if I may also breach the elephant in the room, and that is fiscal deficit. It's not just IMF that's pointing out to higher crude. Moody's has said it will be very tough for India to look at deficit levels of 3.3. In fact, we could end at levels of 3.4%. So both those questions really coming your way. Are you somebody who is in the camp that believes it's all right to have lower growth? Let's not fuss too much over growth levels and the fisc.
I would say I would totally agree with Anant at this point in time. We should not look at having a higher growth. Obviously, higher growth will mean higher consumption of oil, which means at the present prices at which the crude is placed, that will increase the current account deficit, and also if you are not going to let it pass through, maybe because of elections and those kind of issues, maybe fiscal deficit will also go up. Now, that will not have a sustainable growth as we go along. So, having 7.3 or 7.4 this year is a good growth rate. We have a lot of headwinds. The international scene is not very conducive to India. The financial conditions, IMF also says that financial problems may suddenly hit the emerging markets. Now, when that happens, obviously there will be a lot of problems with outflows into this from out of this country, and exchange rate realigning as a result of that, and these kind of issues may really affect us as we go along. But we need to be watchful, we need to handle these issues as they come along, and at this point in time to have a growth rate higher than this, I think even though we might be close to potential at this point in time, it is not advisable because of the headwinds which are on the horizon. It may not be advisable to shoot for something more than this.
Now, who would have thought that the macros will change so significantly and so much and at such a quick pace that we are going to talk about making our peace with low growth and let growth be at levels these, because higher growth is going to come with its higher set of problems. That's how at such a quick pace macros are changing. But Maithili, I think while we talk about macros, the IMF has talked about crude oil prices. The IMF also talks about tightening liquidity that has led to some meltdown. Moody's has predicted that fiscal deficit levels will be breached. I want to ask you the more big picture question. The obvious impact of crude is going to be on inflation, and now the obvious impact of crude is going to be higher on the fisc as well, especially given how this government has now reacted to crude oil prices, making OMCs absorb, taking some hit of its own, asking states to oblige. Given that scenario, how confident are you that fiscal deficit levels will be maintained, and B, how disappointed will you be if there was going to be more than what we saw happen last week on crude front going into elections? And we've got 3 big states, high stake battles coming up there, and of course elections 2019.
Well, it is going to be very difficult for government to kind of stare higher oil prices in the face and say, no, we will not go down the path of going back on the old APM regime. Yes, they have in fact turned the clock back a little bit by asking the OMCs to share a little bit of the burden, which is very unfortunate. I do hope they don't go further down that path, because if they do, that will be very catastrophic. Because for now, if it is a slight deviation from 3.3 to 3.4, the heavens will not fall. But if oil prices continue to go up and government finds it difficult to resist the kind of populist pressure, especially with elections coming up, it would be quite disastrous. And once we have fiscal deficit going up, we already have the current account deficit at a pretty unsustainable level, that would really jeopardize whatever growth we are having. The point is, yes, we need sustainable growth, and as long as the higher growth does not come through a fiscal or a monetary stimulus, it is okay. So we should completely eschew going down the path of giving a stimulus to the economy, because the economy needs to grow in a sustainable fashion. So I do hope the government does not, it stood very firm for quite some time, finally succumbed, blinked, and that is very inadvisable, but it is going to be difficult for a government in an elected democracy. I do hope the government shows some spine, because that is what we need at this moment.
No, I think it's only fair that I go to Mr. Gopalan next, and I'm coming to you in just a bit, Anant. And Mr. Gopalan, ET now did a story today that there is a possibility of lower dividends from oil marketing companies. And of course, rising oil prices, falling rupee has resulted in some sort of a fiscal quagmire of sorts for the government. What options does the government have to deal with oil? You can't pass it all on to the consumer because, this is an election year and you are a democratically elected government. You're expected to be sensitive. If you're not, going to be put in the dock and questions will be asked on why you're not acting on it. And if you do, you're going to be damned as well, because here is going to be a higher fiscal deficit that you'll have to deal with, a revenue foregone.
Okay, there is one option available to the government, which is to cut down expenditure. Revenue expenditure is very inflexible, which you see bulk of it is on interest payments, salaries and defense and those kind of issues. So, that is pretty inflexible. So, what will the government do? They have been doing, as they doing in the past, cut down the capital expenditure. Now, there also they have a bit of a problem now, because the capital expenditure as of now they say it's almost in tandem with their expectation on a monthly basis. So, we need to see how that is going to be restricted in future. Once again, you have to look into how on account of this oil prices, how on the diesel and LPG, how the subsidy is going up from 24,000 crores, something like about 44,000 crores. That is another already a hike of about 20,000 crores. Then you have a 10,000 crores decrease in revenue collection, thanks to excise foregone 1 rupee which you have done. And don't forget, the fiscal deficit will have taken into account states' fiscal deficit as well. Now, if the states were to cut another 2.5 rupees or 3 rupees on the oil, we do not know how the arithmetic will work out. Maybe that fiscal deficit will also go up. So, all these things will have a real serious effect as we go along. The only way the governments can at this point in time do is to cut down the expenditure, which I think is a very, very tough job, given that we are going into the elections at this point in time. It is a very, very difficult choice for government at this point in time, but government will, I have a feeling that even 3.3 or 3.4, I have a feeling the central government will be in a position to maintain that, but about the states, I am not so sure at this point in time.
And that is where trouble really lies, does it not, as far as the states is concerned. But I want to shift the focus to the currency, and it's only fair that we talk about the rupee today, breaching again another historic low. And Anant, IMF has been very categorical in stating the two things that are fault lines as far as the global economy is concerned. One of them, of course, is the trade wars, and which is why global growth has been lowered from 3.9 to 3.7%. And for emerging markets, the big risk is currency and the contagion that we are seeing of sorts. We are dealing with a very strong dollar. The RBI spoke, the finance ministry spoke, and yet many measures were taken. And you still see that consistent slide. So, and the RBI has very categorically said that they are in the market to arrest acute volatility, not to defend the level of the rupee. Which is the level of the rupee at which the RBI and the government are going to sit up and say, this is the level it can't breach? One thought it was 70, it looks like it's going to be 75, could it be 80 is the big question. And because a weak rupee does eventually eat into some of your other macros that we haven't spoken about so far. So at what level will we see perhaps more action from the RBI, perhaps greater resort to the forex that has been amassed over all these years? And the question also is, should they be doing this at all? And the question also is one of credibility, Anant, if I may. Has the market lost credibility in what the RBI and the government is telling?
I think the market is disappointed with the response so far, and there's no doubt about it. Let's look at the basic vulnerability, Supriya. One, we have a permanent outflow. This year's current account deficit could be $85 billion. Even if we get net FDI of plus $35 billion, we still have a deficit of $50 billion, a permanent outflow. On top of that, over the last 4.5 years, we have seen carry-seeking inflows which have come into the country. Even today, about $100 billion of those flows are residing within the country. This includes FPI in debt. This includes net exporters selling, this includes NRE deposits and pure speculative positions, including unhedged ECBs. All of these are watching very, very nervously as the markets develop. Now, given this combination of core outflows and existing positions which are nervously watching whatever is happening, I think we've got to handle this extremely carefully. It's nice to say that, rupee should adjust to its level and, after all, RER still shows rupee is overvalued. But, too rapid an adjustment, and, we've already seen 13-14% of adjustment this year. Too rapid an adjustment can truly impact our fundamentals. There is reflexivity where markets can impact fundamentals rather than the other way around. We have $515 billion of currency debt. We have people with unhedged exposures. All of that can deeply impact our fundamentals. Now, there is a two-pronged approach that the market is expecting. One is to manage current sentiment, and second, to actually act on the basic core issues which are behind us, the deficit that we have. On both fronts, there is disappointment. We have ample reserves even today, close to $400 billion. We have, unusual instruments which can be used, including monetary policy, and the market was expecting a rate hike on Friday in order to stem, the sentiment on currencies. So using these steps, you can buy yourself time. You can buy yourself 1 year easy. Even if you see $100 billion of outflow from here, that's still 25% of your reserves. You can buy yourself time. The second part, which is the more important part, look, the government tinkering around with some, import duties here and there don't really help. There has to be core addressing of the issues. You have exporters who are not doing well, particularly in sectors like ready-made garments, in gems and jewelries, etc. You have manufacturing, which is clearly struggling for some reason. We are still importing net $65 billion of goods from China, from plastics to machinery to smartphones. Clearly, those issues need to be addressed at a core level. This won't happen overnight, but at least show us that you're addressing some concerns. Get GST refunds for exporters happening quickly. Get ease of doing business for industry as a whole up and running in some form and shape. And then the next big chunk, which I think is also equally important, solve the issues in the financial sector. You won't get sustainable FDI and the investment cycle again unless our financial health improves.
Fair point. Fair point. Just hold that thought, because I want to talk about the global economy as well. And Maithili, for the first time in 2 years, global growth forecasts have been cut by the IMF from 3.9 to 3.7%, and it's all happening on account of the global trade tension. Two quick questions there. Are those fears real, global growth concerns? And B, is this the first of the many cuts that we are going to see, given how much that tension has risen and how potent the threat of a global trade war really looms?
Oh yes, Supriya, this is really a huge concern, because during the high growth years, global trade was actually growing faster than global GDP. But now we've seen a reversal, and ever since President Trump has come to power, we're seeing that the US is just not playing ball. We've seen trade tensions rise, the US unilaterally imposing sanctions, as it were, and triggering a virtual, a trade war, is to put it very mildly. In fact, it's almost a, one war after the other. And we've seen that the US has renegotiated trade pacts, NAFTA, it has renegotiated with Mexico, it has renegotiated with Canada, and all these trade deals have been done purely to suit the US's own interests. It takes absolutely no interest in WTO transactions or WTO dealings. It's clearly washed its hands out of all multilateral negotiations. So this is really a source of worry, because if the US raises precious barriers, and if the US does not play fair by the fair rules of the game, WTO was all about rule-based trading, and that it is the US is no longer a party to. This could really ratchet up concerns, trade tensions, protectionist barriers, all of which are very bad for growth. So unfortunately, as long as you have somebody like Trump in the White House, I'm not sure we're going to sense is ever going to dawn on the US, and the US will continue to do that because the US economy is growing very well. As long as the US needed the G20, the US was willing to do its best. Once the US economy is recovered, it's completely almost ditched the G20 process. So this is really a source of concern for which I don't see any immediate answers, unfortunately.
Right. Hold that thought, because I think, Mr. Gopalan, I think you're best placed to answer a very obvious question, that obviously the US is keeping its interest prime, and which is why it's panning this global trade war of sorts. And the longer the trade disruptions, the higher the toll on the global economy is going to be. But eventually this is also going to impact economic activity in the US. Is that going to be the wake-up call really then?
I think so. as on date, I mean, Trump feels that his economy is growing very well, and economy can, whether he really realizes that or not, but the fact remains that the economy is growing very well, not because of his efforts, but because of Obama's, I mean, steps which he has taken. Now, I think this trade war as we go along will not have immediately effect on US. After all, the US is, I mean, imports, I mean, world trade is just in its teens of this GDP. So, but in the services, yes, they have got a big chunk. So, my belief is that, I mean, it will not affect US immediately, the economy as a whole, but as we go along, this will leave a very permanent effect on the structure of the US economy, its manufacturing processes, and those kind of things will haunt US for a long time to come. It will not go away in a year or so. So, now that will feed into the whole world economy through whatever the interest rates, the flow of capital across the world to various countries, and everybody will start readjusting. China will start loosening its economy. Now, that will have an impact on Indian exchange rates and our own economy, and that will also have a impact on the commodity prices. And who are all commodity dependent people, those economies, they also will have a problem. So, I have a feeling that it will have a totally unsettling effect as we go along. Mr. Trump does not realize it at this point in time, but it will have a permanent impact, permanent damage on the world economy.
Right. Maybe Mr. Trump realizes this, he simply just doesn't care. I think that is a fairer assessment than the fact that he doesn't realize it. He perhaps is a leader of the free world who doesn't seem to care. But Anand Narayan, many people believe that this cut in global growth by IMF and this red flag that it's raising on trade tensions and these rising trade barriers is going to make it imperative for US or its trading partners to go in for deals, to sign trade deals. Do we expect a deal coming in from China? Is that a realistic expectation to make at this stage?
I wish I knew the answer to that, Supriya, but I do think at some stage a solution will be imperative. Just as Mr. Gopalan was saying, Mexico and Canada have signed up, so has Korea. Eventually, I think China will come on and sign something as well. But this will take time. It won't happen overnight. And this is the big daddy of them all, the US-China trade deficit issues. In the meantime, unfortunately, things don't look good for us. As Mr. Gopalan was mentioning, the US is in a good spot as of now, and we don't know when the troubles there will start. And the US Fed is still expected to go at least 3 more hikes between now and the next September. US 10-year treasuries are already at 5-year highs and climbing even further. So the withdrawal of money from emerging markets will continue in the interim. In a sense, lowering of global growth might help bring down commodity prices, including oil prices for us. But unfortunately, we can't count on that because there are other issues, including geopolitics and Iran sanctions and all of that, which is impacting oil prices. So unfortunately, all of this puts us in a tough spot. We can pray and hope, and they tend to be our national strengths, to hope and to pray for better days from an external perspective. But they can't be a cornerstone of our national strategy. We unfortunately have to prepare for the worst and therefore tighten up and try and manage, buy some time, address the current account, address your fiscal deficit, and try and clean up the banking and financial system.
Okay. I think the prescription has to be you do all of that and a lot more, but don't turn your back to liberalization. At least that's the message that's being delivered out of India, and perhaps that's a dangerous message that's going to go out. But having said that, thank you very, very much, Maithili Bhusnurmat, Mr. R. Gopalan, Anant Narayan, for being with us on this edition of the India Development Debate. 74.39 is an all-time low for the Indian rupee to close at. This is the new world that we're living in. As far as the IMF is concerned, there are 2 big concerns that compound the global as well as the economies in emerging markets. It's the currency fears and the crash in currency for the EMs, whereas for the world at large, trade barriers and trade tariffs going higher is a huge spot of bother as well. We take a quick breather and back with plenty more right here on the India Development Debate.